Herzlich willkommen bei der Edelstoff Media. Ich spreche heute mit Francois Collet, einer der Portfolio-Manager des DNCA Invest Alpha Bond. Mr. Collet, how do you assess the current development and the outlook for the bond market in 2024?
Money market will still be an important competitor for the fixed income industry in that sense that yield curves are deeply inverted, and that means that you still get more carry being invested in money market than in bonds. Nevertheless, 2022 performance are not going to repeat anymore. We have a much higher level of yields, very few possibility from central banks to hike further, so that should prevent the fixed income market from doing a negative performance anytime soon this year. Nevertheless, we think that most of 2024 performance has already been done in November and December of last year. We've seen a huge rally in the fixed income space in November, December, which has pushed up performances of around 7% in the last couple of months, and that is already in advance of what should be the market this year.
Which types of bond do you see as promising or risky for global investors?
So we think that EM bonds are an interesting opportunity. We think as well that there are a lot of opportunities in the FX space, in that sense that there is very large short-term rates differential between all economies, and that this should be taken into account to build a very interesting risk-reward profile sub-strategy, being long of some risk-on currencies on top of being long of risk-off currencies, can help you enhance a lot the risk return of your portfolio. We think that every credit market or credit opportunities that is below the depo rate of the ECB is a risky asset, in that sense that you may not benefit from the cutting rate cycle that is expected by the market, and even if this cutting cycle starts, you could lose from the widening of spreads. So we would stay very far from any corporate issuer below 4% in euro currency.
Everyone expects interest rates to fall multiple times this year, but what happens if that's not the case? How do you prepare for this situation?
I think that it's a very high probability that central bank under-deliver what's priced by the market today, and this will impact or would impact negative performance or disappointing performance from the fixed income market. So what we think is one should be prepared for that, being very low in terms of duration. Doesn't make sense to buy long-term bonds when they are well below money market rates, and that's the best advice that I could give, is to be patient before adding duration in any portfolio.
To what extent do geopolitical events influence your bond strategy?
Yes. In fact, geopolitical tensions are rising quite a lot since 2019, and we think that they're not going to go away anytime soon. It's very difficult to predict these tensions rising, and what I think which is very important is that the rise in geopolitical tension is going to have a huge impact on inflation. This means that we should see a rise in commodity prices. It's been the case for the invasion of Ukraine by Russia. We are seeing some tensions in the Red Sea, which are increasing cost of transportation as well. So I think that it's difficult to predict, but one should tend to prefer allocation toward inflation-linked bonds, which are going to protect yourself against a rise of inflation in that kind of environment.
In your opinion, what's the best bond allocation for a diversified portfolio in 2024?
So I would say stay short in terms of duration, add some inflation-linked bonds to prepare for any rise of geopolitical tensions, a pinch of some emerging markets as well, which should benefit from the tightening of spreads between EM and DM countries. Some currencies should be added as well to a portfolio, well diversified currencies, and on top of that, some steepness should help prevent your portfolio against any downturn and any quick cut from central banks.
Thank you, Mr. Collet, for this outlook. Danke auch Ihnen fürs Zuschauen und bis zum nächsten Mal.